You're watching BCTV. We're all about Branford. You're watching BCTV, Branford Government Television, a service of Branford Community Television. This program is brought to you in part through the support of the town of Branford.
We're going to get started for the regular meeting, Town of Branford Board of Finance for January 26, 2026. First on the agenda is to consider and if appropriate, approve minutes from the December 29th, 2025 special meeting, the November 3rd, 2025 special meeting, and the October 27th, 2025 meeting. I would assume that the board members were able to get on the link and look at the minutes. Is there any questions, or somebody want to move that, or do we want to defer it to the next meeting? What's the pleasure of the board
I
members?
move that we
Joe?
accept them as presented.
I'll second.
Okay, motion's been made and second. Is there discussion?
Yes. Do you hear me? This is Al Bertolini. Do you hear me?
Hi, Al. Sure.
I've only been a member for that last Board of Finance meetings. So can we separate these out so I can just vote on the December meeting?
Sure. Why don't you want to take that one first, Yvette?
Sure, sorry, I muted myself.
Okay.
I make a motion that we approve the December meeting minutes.
I'll
Been
second.
made. It's made and seconded by Deborah. Discussion. All in favor?
Aye.
Aye.
Okay. And
Now I'll make a
Now-
motion that we accept, can I put the other two together, November 3rd and October 27th?
sure.
Yes.
Okay, motion's been made by Yvette to accept those minutes.
I'll second.
Somebody, seconded by Deborah. Discussion. All in favor?
Aye.
Aye.
Okay, thank you. Okay, next is citizens communication. Again, if there's someone in the audience who would like to comment on tonight's agenda items, they're welcome to do so briefly. If they would raise their hand, then we can make sure we identify you and let us know who you are. Does anybody want to have any comments with regards to tonight's meeting? You see any hands, Trista? Okay. Okay, so then we'll move on to item number 3. Thank you. To hear presentation from Focus Partners regarding the performance of the town of Branford's police pension plan for the quarter ending December 31st, 2025. Then we'll follow that, the next several items by Focus Partners to look at the OPEB trust, the volunteer fire, as well as the coastal resiliency fund. So, Michael, I think you're up on this.
Okay, thank you, Mr. Chairman. Good evening, everyone, and hope everyone's dug out. I hope you probably got a little less snow than we did up here in the Hartford area, but we're at about 18 inches, so hopefully you have a few inches less down by the coast, but I suspect not too much. We'll do a brief market overview. I know this will be Mr. Finch's last exposure to the acronym in his official capacity. So let's start with that, which is BEEPS, starting with B for bubble, moving on to E for the economy, second E for employment, P for productivity, and lastly, S is our strategic asset allocation. I know you have a lot of a big agenda tonight with the actuaries, so I'll be as brief as I can. I think starting with bubble, that's a word we're hearing an awful lot about, and people are concerned, particularly that there's a repeat of the dot-com boom and bust. We're not so concerned about that because we do think that the AI spend is ultimately a real spend. However, the potential concern is how quickly the uptake is going to be for all the tremendous amount of spending, and in particular, the many of the so-called Magnificent Seven, are essentially transitioning their business from asset light, software focused businesses more to asset heavy infrastructure businesses. And historically speaking, anyway, as companies do that, or infrastructure heavy businesses tend to have lower growth, and so that is one of the things that we're kind of watching right now, and we're starting to see, little inklings of that in the market. That as some of the big tech names, if their earnings and their growth of earnings are not what the market's expecting, the market will take those names down in some cases rather aggressively. We just saw that with Intel and more recently down about 17% in one day. But big picture, we continue to be constructive on the AI build out as well as the potential for U.S. growth. The economy continues to be quite strong. Ahead of expectations, GDP grew at 4.3% in the third quarter, and the inflation rate continues to move downward. CPI down to 2.7% in November, from 3% where it was in October. And we continue to see wages are actually growing at a slightly faster pace than prices. So we're seeing a real improvement or post inflation improvement in wages. That's the good thing. The bad thing is, however, that people don't always process things through that lens. And that gets to where we're showing a little more concern on the economy, and that's the second E for unemployment. Job creation has been lousy. We had only 67,000 jobs created in the 3 months ending November 30th. And that has resulted in consumer confidence and expectations that continue to be weak. It's a bit of a irony, if you will, because although unemployment has been creeping up, job creation has been weak. Quit rates have come down, all indicating that folks are a little less confident in their overall situation, as well as consumer confidence coming down. However, that notwithstanding, consumer spending continues to be quite strong and has actually cycled up. It was at 3.5% for Q3 versus a rise of 2.5% in Q2. And so, interestingly enough, we continue to see this kind of contradictory message from consumers that they feel things are really bad around them, but they don't feel that it really impacts them directly. And so consequently, we're actually seeing consumer spending has continued to be strong. And why is that important? Because that accounts for about 2/3 of our economy. The P is for productivity, and productivity ultimately is the big kind of wild card. When you think about economic growth, where does it come from? It comes from growth in population multiplied by growth in productivity. And we don't have population growth to any great extent. And so consequently, in a lot of ways, we're relying on a growth in productivity for continued economic growth. And that brings us all back full circle to the AI question. Is AI going to live up to its expectations and really stimulate productivity in the overall economy? Or will it disappoint to a certain extent? And the risk there is if it does disappoint and doesn't add to tremendous productivity gains, we risk finding ourselves in kind of a similar situation, more akin to Japan or Western Europe, where we have a kind of a stagnant population growth, an aging population, and in demographics that are not favorable. That's not to say that that necessarily signals an impending recession, but that is arguably the biggest risk on the horizon over the next, say, 18 to 30 months or so. Is that kind of the use case, if you will, or the evolution of AI, not just as a technology, but as something that people and businesses can really use to improve their productivity and profitability, comes in, kind of slower at a disappointing level. All of this comes full circle to the S, which is strategic asset allocation, and that has always been and continues to be the biggest driver of long-term returns. You're going to hear from the actuaries later on at just how well funded the plan is through a combination of prudent asset allocation as well as prudent, robust contribution policies, and put those together, and that tends to lead to long-term success of any asset or any pool of assets. The Branford pensions and OPEB for that matter, and not being any exception to that. So, big picture, we're constructive on the overall economy. However, the biggest potential risk right now is that jobs growth and productivity weaken consumer spending, which bleeds over into softer economic growth. So, with that as a backdrop, let's turn to the book. And would you like me to share my screen, or does everyone have the book in front of them?
Tim, could I ask you a question?
Of course.
This is Fran Proto. When it comes to employment, with what's happening with all the investment here from abroad, if in fact that takes place, is there any factoring in of that product of that employment in those numbers as of now, or will they be factored in sometime in the next 6 to 24 months?
Yeah, that's a great question. And I mean, the short answer is to the extent that those jobs have been created, they are included in the numbers. But should we have further jobs growth from further development and build out domestically, then that is a potential plus side to the jobs picture. But as it sort of stands now, we're in this kind of gray area, if you will, or in between time, if you will, where there's a tremendous amount of spend on the AI build out, which of course creates jobs in and of itself. However, we're also to the retooling. I'll use air quotes on that. That's kind of an old term back from the 60s and 70s when factories sort of started to automate. But we're potentially in this point now where people need to reskill, maybe is a better term. And we have this, arguably this in between time, if you will. I think Microsoft, the chairperson of Microsoft said it best that he anticipates hiring will be slow for the next year or so, and then we'll really jump into overdrive as people kind of reskill themselves, and really the need for corporations to actually use and leverage AI becomes more and more prevalent.
Thank you.
Okay, Michael, you want to move on to the police pension?
Yes. Would you like me to share my screen, or does everyone have a hard
Yeah,
copy
why
in
don't you
front
share
of
your
them?
screen?
Okay,
That's
sure.
That's fine.
Just bear with me a moment, please. I think I'm on the.
Oh,
Whoops.
felt too well tonight.
Okay. So can everyone see the
Yes.
Yeah.
booklet? Okay. Apologies. I'm just still to this day a little bit slow with with Zoom. So we'll start with the pension at 35,000 feet. We have continue to see continued progress in the growth of the fund. Total return for the fund going back to the inception date in late 2002 was 263%. That's an annual return of 5.83%. That does lag behind the policy a bit, which is at 6.05%. And as we've discussed in the past, that's come with slightly less volatility. about 3% less volatility is defined by the portfolio beta. So that's led to a slightly negative alpha, which is a measure of value added. It's essentially zero, but slightly underperforming on a risk-adjusted basis. Why is that? Fairly simple, and that is essentially that we have, on many occasions, and including in the current market, been overweight to cash in a rising market. So the underlying investments are doing exactly what we would expect them to do. However, from an asset allocation point of view, the slightly more conservative trend of the pension plan in a rising market has led to some relative underperformance. On an absolute basis, numbers continue to be quite strong. You can see in the blue line is the actual experience of the plan. So we returned 10.62% in 2025, certainly well ahead of the 6.5% that your actuary is using. For the 5-year number, where we're still working off a tough 2022, a little bit lower at 5.29, and then the 10-year number spot on, really, with the assumption at 6.22%. As mentioned, the underlying investments we can see here, the various equities. Strong returns returned just under 19% in the aggregate for 2025, whereas bonds returned just north of 6%. The bonds are also liability matched, so that the bond performance tends to move in sync with asset prices and interest rates. And then we have the high yield bonds, which have added relative value in the fixed income space. One thing that's noteworthy is we see the underperformance of the high yield bond portfolio kind of across the board. This is one of the few active strategies that we have for the portfolio, and in particular, the high yield bonds. We honestly expect this sort of underperformance persistently, and that is simply because of the approach of your high yield manager. You have a very conservative high yield manager in New York Life, and so consequently they tend to have much lower exposure to the double C and triple C bonds, which are the lowest quality bonds. They're much more heavily weighted in B, double B, and even some triple B bonds. So we do expect that they will underperform the benchmark over time, but ultimately the high yield bonds are in there for added return above and beyond core investment grade bonds, and they continue to provide that. And then as cash, as I mentioned, although we've gotten some decent returns on cash, 4.35% for 2025, we are overweight in cash at 7.62% of the portfolio. We're going to talk about that shortly. For the folks that are new to this board, that was part of a decision that was made last year when a one-time excess contribution was made, and immediately a good chunk of that was invested in bonds. However, the portion that would otherwise be allocated to stocks was kept in treasury bills pending the completion of the actuarial valuation. That's been completed. We reviewed it with the actuary and the finance director, and you're going to hear more about that, as well as the recommendation to rebalance later on. So with that, I'm going to
Marco,
Yes.
excuse me, can I ask a question?
Of
This is
course.
Al Burley.
Hi, Al.
Marco, on the bar chart that introduced the section,
Yep.
you have, I guess it's the actual results versus the policy. What is
Correct.
the policy?
The policy is a blend of benchmarks consistent with the underlying target allocation. And so if you bear with me a moment, I'm going to advance to those pages so you can see it. Okay, so this is the policy going back to 2003. And I'll bring it up more recently to kind of put it in focus, but probably the most significant change you'll see in the policy here is you can see in 21 through 23, and then throughout 23, we're 35% in the Bloomberg U.S. Aggregate Bond Index, and then That in 1/1 of 24, that was increased significantly up to 44.5%. That was part of the work that was done around that time as interest rates rose and equity returns continued to be strong. There was a decision made to immunize more of the projected liabilities, thereby increasing the fixed income allocation and locking in those rates. So the last substantive change to the policy was 1/1 of 24.
Thank you.
Okay, did that address your question?
Yes, great, thank you.
Okay, thank you.
This is Frank, just a technical question, Joe. Is this town policy, is it made by the Board of Finance, or is that done?
This is a policy that the Board of Finance has adopted. We developed it some years ago and have modified it along the way, but this is a Board of Finance policy.
Thank you. I wasn't sure how that worked. Okay, thank you.
Sure.
Thank you. Okay, so bear with me a moment. I have all these documents open, so just bear with me 1 second, please. Okay, so this screen that you see now is the current allocation for the police pension. This is as of January 26th, so this brings us up to date from the report, which was through the end of the year. Okay, and just kind of in the interest of time, I'll focus in particular on these three columns, the column the second from the right, the column the third from the right, and the column fourth from the right. The percent of assets column is where we are as of January 26th. The target policy is exactly that, the target policy. And then the amount to buy or sell is were we to go directly to the target policy, these would be the trades that we would put into place. So big picture, if we kind of focus in on the colored lines here, you can see we're underweight in equities at about 19.6% of the portfolio versus a target of 22.5. We're right on with international equities. We're underweight in alternatives. Those are the real estate and the master limited partnerships, which are the oil and gas pipelines. And then we're a little bit underweight by about 1% in fixed income, but we're significantly overweight in cash. Our target is 3%, and we're at 8.44%. Why is that? That is because of the T-bill that we see here that was part of the one-time contribution. And as I mentioned earlier, it was being held in T-bills pending the completion of the actuarial valuation. So that's been completed. And we've met with the actuary as well as the finance director. And we are, and so at this point,
Well, I don't know what the fuck's wrong.
Well, I'm sorry, did somebody? Oh.
I think that was Henry, but I think you can
Henry,
proceed,
mute
Michael.
yourself.
Oh, someone was just talking. Okay, sorry.
Yeah, someone was talking.
So we have about $2.2 million in excess cash. So that would come out of the money market. You can see there's $100,000 we're contemplating selling in the core fixed income. We wouldn't recommend doing that. We would just kind of do 2.1 million in cash and reallocate there. So the action item or the requested action item for this evening would be to complete the rebalance to get the balance of the one-time contribution from 2025 invested. However, we don't want to sell this $100,000 in bonds, so we would just adjust the purchases down fractionally.
Okay, for board members, questions on this request to rebalance, and if not, I'd like someone to make a motion if that's appropriate.
Question, Fran. So the rebalancing doesn't automatically occur. The board has to approve it at these types of meetings. Is that correct? It's not
Correct.
an automatic once a year type of thing.
No, we have a quarterly report from Michael, and they considered the rebalancing, throughout the year. And if in fact there was a need in between those types of meetings, that would come to the finance department's attention, and the board would consider action on it.
Okay, great. Thank you.
Sure.
I'll just
Jim, you got a point?
Yeah, two things. The exception to that typically is when we make our contribution at the beginning of the year. Those dollars get allocated as a rebalance, and then all the other ones are done on a quarterly basis. The other point I wanted to make out, really as kind of a follow-up to Al's question about the policy, is you saw that Michael pointed out at the back of the report the various components of it. In sort of a broad sense, when you look at this chart and you see what the target policy is, you'll see that 52% in fixed income, and right now there was the 3% in cash. So basically, our policy is 45% in various equities, and then the rest in fixed income and cash. That's our target policy. So our portfolio is basically 45-55. So that's to give you a sort of a global allocation, and then the specific components is what Michael had pointed out. But this rebalance sheet really shows that. You can see when you start adding up the various components of it.
Mm-hmm.
Okay. So I just want to point that out. That's sort of it. This is sort of it. Also can be used as an easy way to see what the target allocation is.
Thanks.
And equity.
Thanks, Jim.
Do I move to accept the reallocation?
I
Are
second.
Okay.
Are we doing this
Motion's
fund
been
by
made.
fund or all
I
of them?
second.
This would be overall based on this presentation, Al. So it's motion been made, seconded by Fran. Discussion by the board. All in favor?
Aye.
Aye.
Aye. Okay. I think we're good on that. Michael, want to
Thank you. Okay.
move on?
Yeah. Okay. So next we will, I'm going to kind of shift into high gear here because I know it's just about 8 o'clock. But moving on to the OPEB trust. OPEB trust, similarly, is a very strong year. We have a somewhat more conservative asset allocation because of the funding level of the OPEB trust is as good as it is. We quite frankly don't need to take that much risk or take as much risk, and so you'll see slightly lower numbers. We're 9.5% or 9.59% was the return for 2025, and you can see the numbers across the top in the darker blue line. Much like the pension, because excuse me, historically we've tended to be a little more conservative with deploying dollars, and we've been in a persistent rising market. We do see a little bit of slippage versus the benchmark. That's not a function of the underlying investments, but more so a function of the asset allocation that we've been overweight to cash in a rising market. But bigger picture. Just moving on to the risk return statistics, we see going back to inception, we've had a return of about 114% on the OPEB, which results in about a 5.4% annualized return, and in a risk quotient about 4% less than that of the underlying benchmark. I am going to show one other thing which we didn't touch on, but I think this is really telling for the OPEB as well. We had, going back to 2011, the initial deposit was about $4 million. Since that time, including a significant deposit a few years back, there have been $22 million in deposits. And then the investments have returned approximately $16 million. So we crossed the $42 million mark for the OPEB. And as your actuaries are going to note in a little bit, your OPEB is overfunded. You not only are in rare company in having a funded OPEB, you're in very rare company having an overfunded OPEB. And so, at first glance, you might say, why aren't we getting higher returns? And I think the short answer is because the Board of Finance has long taken the view of it's kind of it's kind of a team sport, if you will. It's a function of prudently and consistently funding the plan with reasonable return assumptions and keeping the dollars invested, and letting the market do what it does best, which is grow over time, and put all of that together. And we've had very strong experience, and that's borne out by the funding levels and the overall credit quality of the town. So with that, I'm going to switch over to show you the value of the OPEB as of the 26th. And the OPEB as of the 26th was at $42,603,000. Just to give everyone a snapshot, that's growth of about $714,000 since the end of the year. So that's how much the market has provided since December 31st. But big picture, again, kind of focusing in on the dark colored lines, you can see we're about 1.5% overweight to U.S. stocks, about 1.5% overweight to non-U.S. stocks, right on target with all our alternatives, and about 1% underweight to fixed income. And currently, we have a whopping $58 in cash. So normally we would be rebalancing tonight to raise cash. However, in discussions with the finance director, or the finance directors, perhaps I should say, Mr. Finch and Ms. LeBlanca, we had an extensive discussion about this, and the town has other assets that have been contributed by various bodies to the OPEB. So there's plenty of cash to make benefit payments through budget season in other accounts. And so therefore, we do not recommend rebalancing the OPEB at this juncture.
Okay. Jim or Catherine, you have a comment on that?
I guess I want to comment on the other accounts. I just want to make, because that I want to make sure that doesn't get misinterpreted. I know Michael's aware of the context, but for the benefit of the board, I think it's important to clarify. This is so we have a fund, and for those in accounting, a fund is a accounting entity with a self-balancing set of accounts. The bulk of the assets in the fund are in this portfolio. However, we do have this fund also has pooled cash, which is part of the town's overall cash system. And there is money in the OPEB cash, primarily from the Board of Education. So, through the process of reconciling Board of Ed expenses and what the town has sent them, there's a decent amount of cash in there. So what we did probably about a month or two ago is we stopped pulling from the portfolio. We typically would pull about $125,000 a month out on average to meet the OPEB expenditures. You'll see a valuation later tonight, and you'll see that that's about what the cash draw is when you look at the town and Board of Education. So that's why we have a larger cash portion than normal. So what we could have done is we could have bought more assets, but what we opted to do is just kind of hold on the withdrawals. So, and we had that discussion with Michael today, because obviously the first look at this is you see $58 in cash reserves, and I think even to the casual observer, we know that we're spending more than $58 a month for retiree health benefits. But that's essentially the explanation for that. I don't know, Catherine, do you want to add anything to that?
No, I think you're right. Just annually, the Board of Ed sends us the funds that they receive from the Teachers Retirement Board, as well as their retirees, which is where the additional cash came into the pool cash in the general fund. So I think Jim explained the rest of it correctly.
Okay, thanks. And we're comfortable in leaving the equity side a bit over target at
Correct.
this
We
point.
discussed that, and we typically use a 5% variance of your equity to fixed target, and you're well within that. So you're at about half of that, and so that was the rationale behind not um, going back to target. And also just for the just kind of a reminder for the Board of Finance or for the new members, the overall asset allocation for the OPEB is by most standards very conservative. You know, we talked about we're 45% in equities for the police pension, which compared to many of your peers is pretty conservative. For the OPEB, you can see we're 68% in fixed income and another 2% in cash is the target. So we only have a 30% allocation target to equities already. So the fact that we're a couple percent above that, we're comfortable with. Mr. Brooks, you have a question?
Yeah, sorry. This is all very new to me, and I'll probably have a larger discussion with Ms. Lavanka and Mr. Finch on this. But you just said that the growth was 770,000 last year on this fund, and then, but our expenditures on this fund are, as I heard from Mr. Finch, about 125,000. It seems to be covering that per year. Am I correct in that's what you said? And
It's
then
about 125,000 per month.
Month.
per month. Okay,
month.
so
Yeah.
if we're spending, so that's that's a lot more than that. That's probably what, close to 1.5 million. Is there, are we trying to get to a point where the fund generates enough income to cover those expenses? I guess that's my question.
Yeah, if I may just clarify a couple of things. The 714,000 that I referenced that's on the screen, that was the change since December 31st. So that's for the past 3.5 weeks. That wasn't for the full year. The return on the OPEB for the full year was right here. You can see trailing 1 year, the net outflows were $1.5 million, and the net investment change was positive $3.75 million. So it was so that the metric that you were referring to earlier was positive by $2.25 million last year.
So we just keep reinvesting that into this fund.
Correct.
The excess gets reinvested into the fund. What would be and this may be a premature question, so I apologize, or it may be not an appropriate question here, but what would be the downside to taking some of that money if we are comfortable, and I don't have the answer, so somebody will chime in, but if we're comfortable that we are producing far more revenue than we need as an expense, what would there be a benefit to move some of the profits to other funds? So you talked about, Mr. Lepore, about how we are in rare air. So why don't we use that rare air to help us with the other funds, or is that just not appropriate or not feasible?
Could probably
Jim,
at least.
Joe, would you like me to address that, or do you wish to?
Yeah, it's probably
well,
between Michael and Jim, and I think the actuaries, when we hear that presentation, I think
Right.
that's a good time to ask that question, Josh, as to what the future looks like with regards to, like right now, the town contribution is minimal, so it's pretty much, it's well to self-funding. The question is, is there any action we should be taking because of that position? So why don't we defer that until we have the actuaries present?
Fair enough.
Okay.
Okay.
Thank you. So moving on, and it's an excellent question. Don't get me wrong. It's one of those things. It's a straightforward question, but the answer is quite complicated, and there's a number of moving parts. So I think deferring it to the later makes a lot of sense. So going to the volunteer fire plan, also a very well funded plan, overfunded. Or slightly overfunded, should I say? I think it was about 102% funded as of the valuation. But we can see here the only difference here between the police pension and the in the volunteer plan is because of the size of the volunteer fire plan, we use a Vanguard bond index. Rather than a customized bond portfolio, and we can see that the return for the trailing 1 year was at 13.45%. In the interest of time, I'm just going to skip back to the if I can find it, rebalancing spreadsheet. And we can see here for the volunteer fire, again, just kind of focusing on these various colored lines. We're pretty much spot on with our target. You can see about 80 basis points over in domestic bonds, about 1.4% over, or excuse me, domestic equities, about 1.4% over in international equities, although a little bit underweight in alternatives, and a little underweight in fixed income, but also a bit overweight in cash, which will be spent down for benefit payments. So much like the OPEB, no recommendation to rebalance the volunteer fire plan this evening.
Okay, thanks, Michael. Any questions on this on the fire pension plan? If not, we'll move to the coastal resiliency.
Okay, and then wrapping things up with coastal resiliency. This is also we can see now this is a little bit different of a portfolio because it's there are restrictions as to how it's invested from by statute. But with strong returns in both stocks and bonds, also a good year. We had a 10.6% return. And going back to inception, just over 4% return. And this inception date is going back just under 5 years. And again, just to kind of reiterate the point about the strength of the finances of the town, this coastal resiliency fund is we can count on one hand the number of them that even exist, much less are really being regularly funded. So really good story here. And then moving back to current values. And we can see we've had a little bit of appreciation, about $33,000 in growth since the end of the end of the year. And similarly to the other portfolios, we're a little bit overweight in equities because of the equity strength, a little bit underweight in alternatives, and a little bit underweight in fixed income, and then correspondingly overweight to cash. So, but in the grand scheme of things, we're quite close to policy, and therefore do not recommend rebalancing at this juncture.
Okay. Thank you, Michael. Any questions from the board with regards to Michael's reports or recommendations? Okay. Thank you, Michael. And are you going to participate or listen in on the actuaries next agenda item?
Yes, I will be here. Thank you, Mr. Chairman.
Okay, thank you. All righty. So we've moved on to item number 7 now, because we've taken care of those presentations. And item number 7 is to receive an update from USI Consulting Group pursuant to the recently completed actuarial valuations for the Police Retirement Fund, Volunteer Fire Pension Plan, and the Post-Retirement Medical Plan, or OPEB. Welcome, Steve and Stefan. You want to take the lead, Steve?
Yes, thank you, Mr. Chairman, and thank you for having us here tonight. Before I get started on the presentation, I just wanted to mention that it's kind of a bittersweet meeting for me because just under 4 weeks from now, I'll be retiring after 37-year career as an actuary. And so I appreciate your confidence in me and the firm over the years and the trust that you've put in us. Enjoyed working with both the town and the board. I have my colleague Stefan Shakurta with me, who's also a consulting actuary with extensive experience in the public sector. We worked on many plans together over the years, and I know you'll enjoy working with him. He's going to cover the OPEB part of the presentation. I'll be starting with the pension plans. So, Mr. Chairman, if I may share my screen.
Sure, thank you.
Okay. Make sure I got this right here. Make sure. No, that's the wrong screen, right? Let's see here. Okay, can you see that?
Yes.
Okay. So we're talking tonight about these are biennial valuations. So the two pension plans have 2025 valuation dates, and the OPEB plan has a valuation date in 2024. So as I mentioned, I'll be starting tonight's agenda, purpose of the valuation, and giving some details for both the police pension and the volunteer fire in terms of the results since the last valuation, and then turning it over to my colleague Stefan to talk about OPEB. I always like to start the presentation with the purpose of the valuation because I think it provides a useful backdrop on how the valuation fits into the life cycle of these funds. And we focus on this kind of gray box here. We're talking about the town's ultimate cost of these plans. When we say ultimate cost, meaning how much cash is the town going to contribute over the life of the fund, whether we're talking about pension or OPEB. And that's money into the fund from the town's perspective. And by definition, money into the fund over its life must equal money coming out, which is really the first two pieces here. Benefits paid to retirees, any administrative expenses you're paying from the trust itself. But you are investing the money. And so investing the money has a large offset to that ultimate cost. Every dollar of investment return you can generate on the trust fund corpus will reduce the town's contribution over its life, dollar for dollar. And employees, by the way, are contributing on the pension side. They are contributing as they're working contractually, so they're self-funding a piece of that benefit. On the OPEB side, the employee contributions are really akin to retiree cost sharing. Retirees are paying typically some portion of the premium upon retirement. So this must be true. This equality over the plan's lifetime, money in needs to equal money out. So how does the valuation fit into that? Well, the valuation is, think of it as a snapshot every 2 years for your plans of where you're at. Where are the assets relative to liabilities? How do we take that snapshot and allocate a portion of the lifetime ultimate cost of funding to just the next couple fiscal years? So that's really the purpose of the valuation. We'll get into some more details on that tonight as we go through the plans. There are two key pieces to that contribution called the ADEC, or Actuarially Determined Employer Contribution, i.e. the town contribution. The first piece is the normal cost. That's really to keep current. Your active members on the pension side are earning an additional year of service. Their pay is going up. So they're earning additional year of service towards that ultimate pension benefit. So you got to fund that just to stay current. And then there's a past service cost or an amortization of the unfunded liability. Think of the unfunded liability of the plan as the mortgage of the plan. So to the extent the assets do not cover the liability, that mortgage needs to be paid off over time. To Mr. Brooks' question, and this is going to be particularly important on the OPEB side, to the extent you're in surplus, then some of that surplus is going to be recognized over time to reduce your ongoing current cost of funding. And Stefan will get into that in a little more detail when he goes over the OPEB. In terms of the police pension, what happened since the last valuation in 2023? The funded ratio, you can see, is noticeably higher. It's 86.3% as of this valuation versus 70.5% in the prior valuation. The town's contribution, or ADEC, came down noticeably from 1.72 to 1.233 million. The biggest driver this cycle was that the town made a pretty significant additional funding contribution during fiscal 25 to the tune of about 6.5 million in excess of the ADEC. So that really did was, as we took this snapshot, 6.5 million more in terms of cash or assets were in the trust than expected. And if there's more money now in the fund, that's going to drive up the funded ratio, assets relative to liability. And you've really kind of front loaded or prepaid a portion of that mortgage payment you would have made over time in the future. So reduces the ADEC. So that's the biggest driver. Aside from the additional cash, you had a couple things going on with respect to assets and liabilities. Assets, although the market value is strong over the last couple of years, 8.3% on average. As you know, we use a smoothing technique, just as almost every other pension fund and the public sector uses. That dampens the ups and downs in the market. In good times, it kind of slows things down in terms of the gains you're capturing in the short term. In times that are not so good, which in this case, we're still bringing in the down market of fiscal 21-22 because we haven't fully phased in those losses yet. So it's putting a drag on, at least right now, for the next couple of years until it's fully recognized, 5.5%, which is the smooth return. That's really the one that we use when we're determining the funded ratio and the ADEC. So in the short term, slightly unfavorable on the asset side. On the liability side, there was also unfavorable experience. Salary increases on average were higher than expected. We did go back and talk with the town about that. There was a contract settlement and so forth. We took that into account, but even after taking that into account, there was still an actuarial loss. We had retiree mortality losses. What that means is fewer deaths than expected. So that's a loss from the plan perspective because retirees are living longer than expected, i.e. more benefits being paid.
Question.
Yes.
What does the town have a specific ratio they want to be at before a significant contribution is made to make up for it, like the 6.5 million? Just I'm being new. I'm not really sure how that works. So,
yeah, no, it's a great question. All the actuarial methods and assumptions are designed to drive the funded ratio towards 100% incrementally over time. So, just going back to the prior slide, for the police, it's a 15-year period.
gotcha.
Or it's 10, and then OPEB it's 22. That's funding policy, and those are all well within best practice. It was, Jim Finch can add some more commentary perhaps to that decision, but that was a strategic funding decision to accelerate that timing. There was nothing really significant, from an actuarial perspective that would drive that. But Jim, I don't know if you want to speak to that.
I mean, Fran, unofficially, what we've tried to do is try to at least maintain a 70% funded ratio. And there's times where we've dipped a little bit below that. And the 23 valuation, we were right at 70%. And so what we did last winter in February is, we're looking at redeploying some dollars. And the question is, well, how best to redeploy those? And when you look at a assumed rate of return of 6.5% in the police pension fund versus what a lot of the other investments were, we were looking at putting extra money into the police pension plan. And myself and the chairman of the Board of Finance looked at a couple different scenarios. And basically, what we were trying to do is give ourselves some cushion, and we were shooting for roughly north of 80%. And so we figured if we're going to make a contribution, let's make it count. And so, and then we were waiting to see the results of the valuation, and it actually came in a little bit better at the 86 and change. So it's not a hard policy. We have a policy with regard to funding it. But in terms of our funded ratio, it's really somewhat aspirational. We want to always keep a minimum of 70%. And also that's something that the bond rating agencies look at. When they look at your debt, they look at your bonded debt, and they also look at your pension and other post-employment benefit liabilities.
Sure.
There was a couple of years back where we really improved it again to get close to that 70%, and that contributed to upgrades along the way over the years. So I don't know if that
Thank
answers
you.
your question.
Totally. I didn't mean to hold up the meeting. But thank you. Now I clearly understand. Thanks.
So I got a question.
Go ahead, Al.
On that arbitrary contribution of the 6 million, that was based on we just wanted to pre-fund that. I mean, there's no compelling reason that we had to do that, huh? Because it was on an actuarial process.
Yeah, that's a good question, Alfred. But for the benefit of history, not sure I would characterize it as no compelling reason. I think that that decision was really part of about 10 or 11 items that we were looking at because we were in the reval. And so one of the things we were looking at was, well, how do we make certain moves and decisions to reduce the tax requirements for the 26 year? And so one of the things we were looking at there was, one is to increase the funded ratio, but also to reduce contributions and future budgets. And so if you see on that slide, the second bullet, where it talks about the actuarially determined contribution ADEC for 26-27, you can see with that valuation, the benefit is lowering those contributions. And we had done some math even back then, and we had lowered our contribution in 25-26 as well. We do have a policy that strives for 100% of funding the ADEC, but it also allowed for, depending on other circumstances, to fund, I believe, 90%. And so I believe the roughly $1.5 million and change in the current year budget was, reflecting more on that 90%. So there wasn't this, strong statutory requirement to do this, but there was a budgetary reason for doing it. There was a desire to get our funded ratio up, and there was a desire to better utilize the dollars in the medical self-insurance fund because, that a large portion of that was deemed to be surplus because the town probably 3-4 years ago went into a different medical plan, which had some benefits on the operating side as well as on the OPEB side. We still are self-insured for dental, so we didn't close the fund down entirely. So I guess that's my long-winded way of saying there was a lot of reasons to do it.
Yeah, Jim. Thank you. And also, I wouldn't call it arbitrary because, as you point out, the 8.5 million, I believe, or was a little over 8 million that was in that fund, we moved 6.5 over to the general fund. So, but instead of adding it to fund balance, we moved it over to the police pension fund, leaving, as you point out, over $1 million in the medical trust in order to take care of any type of lingering liabilities. So. I do as well developed strategy, Al, that was part of last year's January, February, and March meetings. Okay. Steve, you want to carry on there?
Yes, thank you, Mr. Chairman. Just every valuation, we look at assumptions and whether we want to maintain certain assumptions or potentially change them. The key one that we always look at is investment return, long-term rate of return on the assets. Current assumption is 6.5, as you know, and based on our models, based on the models that Michael's firm uses, and we do compare notes. We believe that the current long-term assumption of 6.5 continues to be reasonable. Just some benchmarks. We do a survey every year of Connecticut public sector pension funds. Just by coincidence, that is 6.5 in terms of the median in Connecticut. That's not how we set your assumption, but it is a benchmark, and that's in line with the average as well when we kind of slice and dice it by plans with similar asset levels, 6.54%. So you're right. You have a lot of company at 6.5. Some larger funds out there nationally, we're talking generally statewide funds, very, very large cities, hundreds of millions or billions of dollars. I'm sorry, is there a question? Oh, I'm sorry. Show somewhat higher returns in the 6.9 to 7% range, but those are some benchmarks. The other big assumption, and this assumption was updated for this valuation for all the plans, it's the mortality table. So kind of predicting how long retirees live. And that a new table was published in May of 25. It's the second study done in the public sector. The table that you had been using was the most recent one at the time, public sector. So this new table showed that for your public safety, i.e. police, and we use a similar table for the volunteer fire, those life expectancies do continue to improve as expected, but they're actually improving at a more rapid rate than the prior table would have predicted. So that's true in the public safety arena. You'll see when we talk about OPEB, that's not necessarily the case, but for these plans, it is. And since retirees are living longer or expected to live longer, that did have an impact for the police plan of increasing the ADEC by about $22,000. So that's the key. That's the key change that we made for this valuation. In terms of the numbers, just a little more detail on what I talked about a couple of slides ago. I'll just blow this one up a little bit so you can see a little bit better. Membership in the fund is about the same as it was last time, an increase of 2 members since 2023. You see the breakdown between actives and retirees and so forth. Here's some numbers behind the funded ratio. So actuarial value of assets, 38.4 million. Again, this is on a smooth basis as of July 125, against an accrued liability of 44.5 million. So unfunded liability of the plan is 6.1. You can see that's down quite noticeably from last time, again, largely because of the additional cash contribution, which served to increase the funded ratio up to 86.3%. And then there's the ADEC. And again, we're doing these biennially. So we develop the ADEC for both fiscal 27 and 28 as part of this valuation.
Okay, thanks, Steve. Questions on the police pension valuation from the board members?
Yeah.
Okay, why don't we move on to the fire,
Okay,
Steve?
volunteer fire, similar
fire.
format to what I just talked about on the police pension. Funded ratio is up since last time. It's 102.8% versus 98.3, so that's favorable. And the ADEC is down a bit from 40,000 for fiscal 26 to 31,000 for fiscal 27. Did not see the type of cash contribution that we saw in the police plan, so that was not really a big driver here. The asset result was similar, even though the returns are slightly different. Market returns were 10.4% per year on average on a market value versus 5% on a smooth. And by the way, I should have pointed out that the snapshot dates are different in 2025. So the snapshot date on the volunteer fire side is January 1st, while on the police pension, it's July 1st, 25. On the liability side, things were favorable, however, and we've seen this the last few valuations. Not sure how familiar you are with how the volunteer plan works, but it's a points-based benefit accrual. So depending on how many drills the volunteer firefighter attends and how many fires they, calls they make and so forth, they accrue points every year, and they need to accrue a certain amount of points in order to earn a year of service. Well, not as many members earn those points during this cycle as expected, so that meant the accruals were lower, and therefore the liability came in a little bit lower than expected. The town's actual contribution to the fund did exceed the ADEX in total over the past 2 years, but not anywhere near the sort of difference we saw on the police side. So that was really not a big driver. Similar to the police pension, we did pick up the new mortality table. These liabilities are much smaller, as you know, for this fund. So the impact on the ADEC was smaller, about $2,400.
Okay, questions from Steve to Steve on the volunteer fire pension valuation from board members? Okay, if not, then we'll move on to the OPEB. And
yes, thank you, Mr. Chairman. I'll turn this over to my colleague, Stefan Shakurta.
Well, thank you, Steve, and thank you for having me here. I will try not to be too repetitive on some of the topics that Steve had already covered. I'll just kind of point out the things that are a little bit different on the OPEB side versus the pension side. And I do feel like we're kind of going backwards in time, as the pension plan for the police was 7/1/25, the fire was 1/1/25. We're going to go back another 6 months to July 1st, 2024. Like the pension plan, these plans are done every other year, and we happen to measure them on even years. So we did 24, we'll do 26 later on. The first point I'd make out is that the funded ratio dropped from 162.4% in 22 down to 149.8%, so just under 150%. We'll kind of hit on some of the reasons why that happened, and that have to do with assumption changes that we've made. But next, I'll talk about the ADEC. The ADEC also went up slightly from 10,000 for the 24-25 fiscal year up to just over 18,000 for the 25-26 fiscal year that we're currently in. As we saw with the other two plans, there were asset losses. And again, that reason happens to be because we are still recognizing those big losses from the 21-22 fiscal year. So here we're a little further back in recognizing them. So we only earned 4.7% on that smooth actual basis that Steve has talked about already. This is again based on the 6.5 assumption that we had. On a market basis, that average was 6.7%. So the OPEB side didn't do quite as well, and that could be also due to the way they're invested, as they are invested a little differently, that Michael had indicated from the pension side of things. However, on the liability side, there were gains. So that means we did have some favorable experience. A little different than what we see on the pension side, because we have different components or different benefits, things that drive the costs on the OPEB side. And one of the primary ones were that the medical premiums came in less than expected. And that's always a good thing, as we, in the last year or so, we probably have been hearing that they're going to go up, and we'll certainly see that, or we'll find that out when we measure the 26 OPEB valuation, but for this case, they did go down. Another thing that we had favorable experience on was on the demographic side. Although we do still have the same retirement, disability, termination assumptions, what we tend to see on the OPEB side is that people tend to drop coverage, and this is where we see some of the gains. When they retire, they may choose not to drop to continue coverage, and they may be covered by the spouse or something. So we tend to see that a little more on the OPEB side. Okay, so we'll go to the next slide. And as I mentioned, this is kind of what Steve had talked about before about how we always look at the assumptions each valuation, and then we talk about any changes we made. Here, first one of the key ones is discount rate, and you kind of use that interchangeably with the investment rate. We call it a discount rate. So they're basically the same thing. So again, we look at the target asset allocation, capital market assumptions. When we looked at that, we recommended to the town that the 6.5 may be a little too high, and you certainly might recall that it was maybe a 70-30 on the fixed side. So we recommend that they lower that. Overall, after discussions with Jim and Mike, they decided to lower it down to 6% for this valuation. That increased liabilities to about 6.8% or about 1.8 million. Again, on mortality, I won't go into the details, but we did update that mortality table. I will mention that Steve did. What he didn't mention was that there are 3 basic tables when we talk about the public sector. You have what Steve already covered, the safety group, and those rates went up, so that means they're living longer. But there's also 2 other groups, and those groups are also in the OPEB. Those are the teachers, so those we'll call them certified, whether it's teachers or administrators. They have their own set of tables, and then you kind of have another bucket that is what we'll call the general employees, which kind of covers everybody else, whether it's secretaries, town hall people, custodians, things like that, all that aren't in the service sector. Even public works will be in there. And both of these tables, the improvements were a little, less, so they found out that people weren't living quite as long. So that means there's some savings on that side, which is kind of the opposite that we saw with the police and fire tables. So that we did see a slight increase, but there are majority of the liability is on the police side. So we did still see a slight increase when we made that change, but only 150,000. So it's very modest. Other changes on the demographic side were retirement, disability, and turnover rates. So there are other groups that are covered on these plans that may not be covered in the pension plan, people that are in the CMERS or in the state teachers retirement plan. And both of those plans did experience studies since the last valuation. So we kind of mirror those because these people are still covered into those plans. We want to mirror those assumptions in the OPEB benefits. So we updated those assumptions. And on top of that, and the final assumption change that we made has to do with the healthcare cost trend rates. And that's how much we expect premiums to go up year over year. Previously, we would start the initial trend assumption to be 6.5%, but for this 24 valuation, we started at 7%. So for 24, we assume premium is going to go up 7%, and then we continue to grade it down by about 2.2% each year to get an ultimate rate of 4.4%. So these assumption changes also increase liabilities by about $1 million. So all these assumptions in combination increased the liability by about 12.3%, and that's kind of why we saw the funded ratio drop from 162% to just under 150% on that prior page. So those are the key things. On the next page is the executive summary. And this is what I always call the key page in the valuation report because it kind of has all the information. Can you blow that up a little, Steve?
Yeah, I'm gonna blow that up a little bit.
Yeah, so this has all the basic information. Again, we have the population. You can see in that first bucket that the overall population went from 667 down to 640. And again, that's most likely due to people dropping coverage. I don't think the workforce has shrunk in the town, but but again, like I say, people do drop coverage because they may have better coverage, cheaper coverage from their spouse. We do show payroll, but I will point out for most OPEB plans, they're not pay-related benefits unless maybe you have a life insurance or if active employees do make contributions based on pay, but that's not the case here. Then we'll see the next 2 buckets, which is, again, the liability and the assets. So here we have liability is about 27.9 million, and you can compare that to the 41.8 million on the actuarial smooth assets. You can see the next line was that unfunded liability, or in this case, overfunded, or that surplus, however you want to look at it. It went from 14.8 million down to 13.9 million. And there's been a lot of talk that surplus and how we look at that, and if you remember in the very first slide that Steve talked about, there's that two components, the normal cost component that makes up the ADEC, that normal cost, as well as the past service costs. And in this case, because we're overfunded, you can almost kind of think of it as a past service credit. So you can utilize some of that surplus or that overfunded liability to help offset your costs, right? And that means your ADEC here is really went from 9,000 to 18,000. But if we didn't have this surplus, say the plan was just 100% funded, your normal cost would be just over 700,000. So you're kind of offsetting that 700,000, really only paying 15,000 or so, with interest adjustment, 18,000 of that. So you're kind of using that surplus for that purpose. So that's kind of a key reason, why you pre-fund a plan, to help offset future costs. Say he put that $6.5 million on the pension side, you reduced your contribution by 500,000 that current fiscal year. So you kind of saw that. That's kind of the case here. You have really small contributions. The contributions, as I said, could be up to 700,000 on an annual basis. But because we have that surplus, your contribution is very small, kind of minimal. So it's much easier to budget at this point in time.
So that, I think that's probably a good segue. Mr. Brooks, you'd asked the question about, if I understood correctly, about, maybe
money.
transferring money out. And so, not being an attorney, but it's my understanding, since this is a dedicated trust fund, right? Just you can't look at it just like a bank account where you can transfer money in and out, or certainly out for purposes other than OPEB. However, what I say to clients is, in terms of the funding of the plan, so you really have three buckets in terms of how that money grows over time. You obviously have investment earnings on the trust over time. You've got, in this case, retiree cost sharing, right? Their retirees are kicking in some money towards their benefits. The third piece is the town contribution. So the town contribution, think about it to what, Stefan said. If the plan was in balance, that town contribution would be north of $700,000. Recognizing some of the surplus over time, you basically take your foot off the accelerator quite a bit, almost down to zero in this case, because you're recognizing some of that surplus. So you're not really taking the money out, but you're putting in quite a bit less than you would otherwise. And every valuation that we do basically trues up the snapshot. I mean, things have been very favorable in the last few cycles for this plan. You've had very good plan experience with respect to premiums for 3 valuations in a row. You've had favorable demographic experience. You went to the state partnership plan for the 2022 valuation. And then back in 2020, we did a wholesale assumption review, which also reduced liabilities. In combination, all those factors really led to your surplus position that you're at right now. And recognizing that surplus and amortizing it as an offset means that the town's contribution on a relative basis is quite a bit lower than it would be otherwise. So hopefully that answered your question, Mr. Brooks, in terms of, how the surplus came to be and how can it be used right now. And from an actuarial perspective, that would be my response. I don't know if you have anything to add to that, Jim?
I mean, it sounds like we're utilizing the surplus now because we're basically not funding the fund at all in our budget each year. I mean, you could say it's 14,000 or 18,000. That doesn't. Yeah. That's not. I mean, that's not in this world we're in. That's not real money. Although Jim would say, "How dare I say that?"
It's all relative.
But so if the question is, and I just want to understand it. This is just me understanding it. Right. So we've got 40. Am I right to say we have 41? Well, we'll call it $40 million in assets in this fund. Right. So in theory, right, you can't take the profits from the fund and move it somewhere else. So I understand that makes sense. And that, I'm also not a lawyer, so I'm going to take your word for it. But can you take, is it possible or legal or appropriate? All of these questions are important, to take, like we did with the dental plan, the dental fund, as self-funded fund there. And I would imagine the fund was similar, and take a portion of that to, while we're clearly overfunded in this fund, which is great. And I don't want to jeopardize that. I got to make that clear. But is it possible to take a portion of that fund and then move that into the police fund as well? And again, I don't have an answer, and I think it's a longer discussion, but I'm just asking those questions.
I can't answer your question on the dental fund because I don't have expertise to answer. But just one thing and I don't wish this on the fund, of course, or anything. All your experience has been very favorable in recent years, which is fantastic. We know that things happen the other way sometimes, 2022, 2008, 2009. So what I would say is you have a pretty noticeable cushion against those sorts of events were they to occur, right? Which is a good thing. I mean, you're in the top 1% of all plans in Connecticut, for example, in terms of your OPEB fund ratio. So that, I'd just say every valuation we're doing a true up or a snapshot based on what happened in the last couple of years, right? So you've got quite a bit of margin there if things were to turn the other way, right? So
and
sorry,
I think
Jim.
also,
Sorry to interrupt, Jim or Michael.
Question? Yes, question. Just kind of a global look at this. In one of the plans, you have a significant overfunding, and another you have a shortage. And I kind of understand the shortage more because you're building it over time. You're going to be fully funded when you need the cash. But on the overfunding, I mean that's huge, and I'm not sure how you get there, how you get something that large, especially when you're looking at it every year or every couple of years. You're looking at it very closely and determining what the next couple of years are going to be.
Yeah.
I mean,
Yeah, I mean that's what I was just, and I didn't really put any numbers behind it, but you had favorable increases in medical premiums for 3 cycles in a row, right? And we've seen other clients where the opposite happens, but you've had 3 of those in a row. I mean, that's generated between the medical premiums and demographic changes, like Stefan mentioned. That's about just over $5 million since 2020 in terms of surplus that was generated. The change to the Connecticut Partnership Plan, which was in 2022, which is a plan change, right? So that's not something that gets anticipated in advance. It just the town made that decision, it happened, and we measured the liability impact. That was about a $4.2 million savings. And then the assumption change, which hadn't been done in a while, but that assumption review back in 2020 was another $3.5 million. So these are chunks, a few million here, a few million there. Favorable experience. Again, it could flip the other way, but in the short term, it's been favorable. Pretty soon you get to $14 million. And so those are the sources of those gains since 2020, which is, an enviable place to be. And right now, the way the town's reaping the benefits is instead of making a $700,000 per year contribution to cover the accruals, because these liabilities are growing with interest and accruals, right? They don't just stand still. Down to about $18,000. So it's unwinding in the short term those gains, the clip of about $700,000 a year until such time that we remeasure it next time around.
Jim, you want to provide some context to this discussion?
Well, it's gone in a couple different directions. When you look at the 2 funds combined, the town is in an unenviable position. So it seems a little perverse to try to defend what we've done, but nevertheless, I will. So
Yeah,
it
I
just,
wouldn't take the inquiries as criticism, but
no,
I
no,
don't
but I'm
think
just
that's the
saying,
way they're meant.
no, I'm not really taking them that way, but it's kind of like, when we started with the OPEB, we were one of the first ones to set up an OPEB trust. We recognized that we needed to fund this, and we had some good things happen to us. And, in hindsight, we wouldn't have put as much in. I think we were putting money in at the time. And then we're getting newer valuations and we're saying, well, wait a second, had we known it would be this good, we probably wouldn't have done it. We did put money into the police fund, as we've talked about. I do think one of the things I would be looking at, and I'll mention this to Catherine as well, is to continue to look at the medical self-insurance fund and whether there is a continued need for that at all, because the dental insurance claims are relatively predictable. So it's conceivable that you would just fund that in the operating budget, and if you were short, you would do a transfer from contingency. If you were over, then that money would basically go back to the general fund, or the next HR director may have different ideas about benefits and may decide that, maybe we go to premium based on the dental side. So there is something to look for there. I do agree that, yeah, that was I was going to say when Josh asked the question during the pension report, that yes, the OPEB is a trust, whereas the medical self-insurance fund was not a trust. The medical self-insurance fund was a special revenue fund, so it doesn't have some of the same, you know, protections or requirements that, one being investing for the exclusive benefits of its purpose and for the participants, which is typically true of trust. Now, if you look at the town entity-wide, I mentioned before about, the rating agencies looking at OPEB and our pension liabilities. When you look at them all together, and that would basically net out. So not to zero, of course. So let's call it 14 million in the OPEB would basically wipe out the 6.5 million liability on the police side. So, in hindsight, could we have gotten things in the right buckets? Yeah, potentially. But in terms of the taxpayer and the liabilities, they are what they are. And some of that surplus is benefiting the taxpayer because we're not actually funding the OPEB at 700,000. Now, if you really want to go a step further, you'd say, all right, fine. Let's take the 700,000, which we were going to do for the normal cost for OPEB, and stick that in the police fund. And then instead of $1.2 million, which is the ADEC for next year, you'd be looking at $1.9 million. Now, then again, you'd be taxing for it, but I don't think that's where the town wants to go, and that's not where I would recommend that we go. So I think what we're doing, given that the cards we've been dealt, which again are very good cards, I think is appropriate.
All right, Jim. Thank you. Appreciate that. And any other questions with regards to these actuarial
I think Michael Lepore had his hand up.
Yeah.
Mike, go ahead.
Yeah, I'll be just a real quick comment. I don't think it's really come up, but I think there's another thing to consider here, and that is that we went from, I believe it was 40% in bonds up to 80%, or 70% rather in bonds when we overfunded the OPEB. And so it's harder to quantify it except looking backwards. But to the comment that Steve was making, having roughly 2x the allocation to bonds, and these bonds are now matched to the liabilities, that's going to greatly reduce the funding volatility or the ADEC volatility going forward for the pension. So it's, again, it's harder to quantify that, but the theory is that will put a much smaller volatility burden on the taxpayers going forward as well.
Thank you, Michael. Josh, are you okay with those
Yeah,
responses?
I think for me it's more informational.
Sure, sure.
I'm not here to I'm not going to set a policy tonight or uh I think it's more informational to understand all of this a little bit, what our options are as a community and as a town. Um, you know, and I cannot emphasize enough that you know on so many fronts when I go to these meetings and I hear the experts that know a lot more about this stuff than I do, and they always say, "Well, the town is in good shape." So my comment only is that that it's a comfortable place to be, more than comfortable place to be. So I'm not. I just want to fully understand what our options are, and now I have a better understanding of it, and so we'll keep moving forward.
All right, thank you. Thank you. Fran, you have a question?
Yeah, just a couple quick thoughts. So this is every couple of years we do the actuarial studies, correct? Is that
Yes.
correct?
Yes.
And
Yep.
it's a point in time study.
Mm-hmm.
2 years from now, and I don't know the historical returns on these funds. And I don't need to see them. It only returns 2 to 3%. That 13 million overfunded account, how much could that, do we stress test the actuarial based on a different market condition? Or do we use 6% just as a roughly 6% over time and just forget about the possibility of a 2 to 4 year downturn where rates are lower, market gets hit, and that 13 million now only looks like 3 million?
Well, right. I mean, so I think short answer to your question is we don't stress test it. We are using the expected return, but every 2 years is a true up to what actually happened over the 2 years. The way that you sort of dampen that impact in the short term is through the asset smoothing that I mentioned before.
Okay.
Basically, we every year we look at what was the expected return of the fund. Let's just use a 6% on the OPEB side, and let's just say that the plan earned 1%, which is 5 percentage points less than that. What we do the following year is say, okay, we had a loss of 5 percentage points. We're going to recognize that loss over 5 years. So we're going to recognize 1% this year, another 1% next year, and so forth until it's fully phased in. We do the same thing when there's a gain. If the market earned 11, which is plus 5, we'd pick up the extra 1 the first year and so forth. So that's called asset smoothing. Mm-hmm. And there's sort of an ebb and flow to that. They roll off, roll on, and that dampens the impact in the short term on the funded ratio and the town's budget. And so, although I don't think that's like directly what you're asking in terms of stress testing, it sort of gets at the same point where we recognize that the market can and has made some big moves both ways, and we don't want things to swing around too much in the short term because of that.
I guess my only to the first selectman Josh's comment, that 13 million 2 years from now, based on the smoothing and everything, could that really be 7 million in 2 years based on the smoothing effect in a downturn market?
I mean, I don't want to say never say never, right? Because
right.
But I think that would be like probably 4 or 5 standard deviations to the bad in combination when you looked at like liability and assets together. Yeah. It would take everything having to go wrong at the same time.
Gotcha. I totally understand that. I was just wondering how fast that 13 million could change. And you guys do the smoothing effect and all that.
Yeah.
But I understand. Thank you.
Jim, you have a comment?
Yeah, I was going to say when I heard that question, I knew where that was coming from, a 300 basis point up or down, right, Fran?
You
But
got it.
but that's what credit unions use.
Yeah.
But I mean, the closest thing we might have to that is in our audit report. There's in the notes to the financial statements, they talk about the impact of changes to pension liabilities based on changes in the discount rate.
Correct.
That's about the closest as you would come to that type of sensitivity analysis, but that's also using market value as opposed to the actuarial value, which reflects the smoothing that Steve's talked about. So, what I could do is I could show you like a page in the audit, not quite what you're asking for, but it does show how changes in discount rates, so you might change the discount rate if your returns were bad, right? So changes in discount rates, how they impact the liability. So that's half of what you're looking at. So
Perfect. That's fine. Thank you. I appreciate it.
Before
Okay,
we move on, before we move on, Chairman Mooney, I just want to thank Steve. I've always been a fan of your work from afar, so I just want to thank him. I just wanted to thank you for everything.
Thank you, Josh. Appreciate that.
yeah. Again, I think on behalf of the board, Steve, thanks for your many years of service, and I appreciate it. Good luck in your retirement. And Stefan, welcome aboard. Thank you.
Thank you.
Thank you, Mr. Chairman.
Okay. All right. So we're going to move on to item number 8, which is to consider and if appropriate, approve the following request and resolution from the Board of Education to increase the following revenue and expenditures of the adult education budget due to the addition of elementary children enrichment programs. And essentially, the increase is $42,490, and so that that will fund various accounts, salaries for $1,500, employee benefits for $390, purchase services for $34,600, office supplies for $500, instructional supplies for $2,500, miscellaneous for $500, and bank services for $2,500. And so the resolution for consideration here is resolved that the Board of Finance recommends to the RTM an increase in the appropriation for the fiscal year 2026 Shoreline Adult Education Fund budget from $72,500 to $114,900. This increase will be funded through additional tuition revenue and will support the implementation of the Elementary Children's Enrichment Program. And I believe we have Blaze on the line here. Welcome, Blaze.
Hello, everybody.
You'd like to handle this request for the Board of Ed?
Yep, I will start. And we also have, I believe, Christine Bjork, who's going to take over. Christine Bjork is the Director of Shoreline Adult Education and runs the program. First, just wanted to welcome the 2 new board members on the Board of Finance. Nice to see you. Looking forward to working with the both of you. I'm Blaze Levitan, Chief Operating Officer for the Board of Education, and always glad to see our partners over here at Town Finance. And so, yeah, Christine will go through the specifics and can introduce herself too. One of the things that, as a high level, I think to think about is, some funding from the federal government for adult education is less stable maybe than it has historically been. And so that has prompted us to consider some ways that we can be creative with our existing infrastructure to meet other needs that the district potentially has or that the community has. One of those would be to use sort of our instructor network to expand some after-school programming at a way that could be a no net cost to the operating budget. It could be funded by tuition. Many other districts sort of use, instead of adult education, they kind of have a continuing education model. So Christine Bjork and her team, they've done a great job kind of looking at ways that we can do some after-school enrichment. Also in the 27 budget, we'll be looking to bring in-house a para-pro program as well. These are ways to diversify the overall program and make it a little more sustainable, as well as to kind of put a boost on the enrichment side, which is the more flexible side. So I want to hand it over to Christine Bjork to take it from here. And Christine, let me know what else you need.
Thank you. Thank you, Blaze. Thank you, Mr. Chairman. Thank you, everyone, for having us. Tonight, yes, I'm really excited to share that Shoreline Adult Education is looking to expand our enrichment program beyond working just with adults and to pilot an elementary enrichment program at all 3 elementary schools starting in March. And to build this budget, we're operating under the following assumptions. We anticipate being able to have 20 to 25 classes per 2 sessions, each 20 to 25 in each session, with a minimum of 8 to 10 students in each class. We anticipate the average cost for a class to be $120, taught by certified teachers, but we will have a sliding scale. So these classes will be accessible to all children in Branford Public Schools. As far as the increases in expenses, the salary non-certified line would go towards our current adult enrichment coordinator. She'll be handling the elementary website, elementary enrichment website, so the classes, the registration, and whatnot. Purchase services and professional technical expenses would include the stipend for the elementary enrichment coordinator, a site supervisor at each school during classes, the stipends for the teachers, and also the cost to build out the elementary enrichment site on our website. The non-instructional supplies would be for snacks for anyone who doesn't have a snack. Instructional supplies would differ by class. So we have a wide variety of classes that we plan to offer. We have some different art classes. We have like directed drawing and crochet and a craft lab. And then we also have academic oriented classes. So there's math enrichment, problem solving, cooperative games, and activities. We have a graphic novel writing class, chemistry fun. We also have some movement oriented classes. So a yoga and a sports class. And then we have a Spanish language class and then an elementary engineering class. So for mini makers, design it and try it. So the instructional supplies will differ across the different classes. I built it in miscellaneous for any unanticipated expenses, and then the bank services fees that we have for registration and students signing up. So that is our budget. We're super excited to move into this new venture.
And Chairman Mooney,
Sure.
I just wanted to add to that what we've done, and Christine's really done a great, I think, job with coordinating. She's done some surveys of existing instructors. And this is also intended, you'll notice in the type of programming she talked about, we did a good job, I think, of looking at parks and recreation offerings. We work really closely with Parks and Rec across the board. We're not competing in any way with Parks and Recreation on this. This is supplementing sort of a different type of after-school activity. And so it's building upon other frameworks that we have. We're separately working where it makes sense with parks to expand, to also do some of that too. Nally's team has been really good working with our health director and some of our principals directly on where it makes sense for that too. So this has specifically been intention to kind of bring all these different resources the town has together without competing or sort of overlapping.
All right. Well, thank you both. It sounds very exciting. Questions on this transfer from board members?
Mr. Chairman, I would like to note for the record that the resolution amount should be changed to 114,990, not 900.
Okay. Duly noted for that typo. Thank you. Thank you. Someone want to move that resolution that I read, or do you prefer me to read it again? Al?
To accept. Move to accept.
Move to, okay, Al has moved. Alfred has moved.
I'll second it.
Seconded by Yvette. Is there discussion? All in favor?
Just one comment.
Sure, Al.
That emblem on your shirt, is that, did you wear the right shirt tonight, for the meeting? Does that say Ellington?
Yeah, I've got
Who's
I
that?
got the wrong shirt on. It says Ellington Fire Department on it.
Anyway,
All right. So we'll still consider a request, Blaze. Okay, all in favor?
Aye.
Aye.
Aye. Okay, thank you, and good luck, Christine.
Thank you.
All righty. Next, number 9 is to consider and if appropriate, approve a transfer request for fiscal 25, fiscal 25, 25, 26, I assume, for the fire department, from communications, 15,000, from CMed, 1,800, volunteer officer stipend, 4,500, longevity, 1,000, for a total of 22,300. And moving into purchase services, 16,000, and other supplies, 6,300, for a total of 22,300. Chief Thomas Mahoney, how are you?
Good, Joe. How are you?
I'm good. I'm good. Thank you, sir.
Good. And this is my first meeting with the new board members, so hello to all of you and welcome. So we are asking for these transfers. Our repairs and maintenance and other purchase services are both expended, barely halfway into the year. Now, I will note that we have approximately 28,000 in repairs and maintenance tied up in blankets and another 5,000 in other supplies. So those are with our various vendors we use for repairs and parts and whatnot to keep things running. But the pressures on these accounts are primarily due to repairs and maintenance on apparatus, as you know, and we've had in many past meetings about the age of the fleet. The youngest in the group is our frontline piece is 11 years old already, and that will. While we have 4 new pieces of apparatus in order, the earliest isn't due until next month. So we've had quite a bit of very expensive repairs to keep these on the road, and that's what's put us in this predicament. And then other supplies is just a combination of the consistent increase in supplies. It hasn't really slowed down any that I can see, and of course we're sharing our building with the police department, so we're using not quite double, but a significant amount. So that's where the shortages come from in these 2 accounts, and we've tried to budget them conservatively, certainly in light of the increases we've had in personnel, and the accounts that we're taking them from communications. We've been able to reduce significantly the amount of communication devices we need this year through we're pretty much had modems in all of our apparatus. We don't need the modems anymore, so each one of those was a charge, as well as our cellular telephone use is way down. CMed was just the balance after their invoice this year. Volunteer officer stipends, that is actually coming out of the main stipend account, so we're just going to ask that you move the money from one line, that line, into these lines, and then we should be fine in the overall stipend lines at the end of the year. And lastly, longevity is just due to retirements.
Okay. Thanks, Chief. Questions on this transfer from the board members? Okay, somebody want to move it?
I'll move it, Joe.
Second.
Moved by Deborah, seconded by Fran. Is there discussion? All in favor?
Aye.
Okay, thank you, Chief, and take care.
Thanks, board. Appreciate it.
Okay. Item number 10 is to consider and if appropriate, approve a transfer request from the general government buildings for $4,000 from fuel oil and moving that into uniforms and clothing for a total of $4,000. Brian, you're on the Zoom here. Welcome. I think you're on mute.
You hear me now?
Yes, sir.
Yes, the 4,000 for into the uniform and clothing is for the uniforms for my custodians, which is provided by Cintas. When I did my budget last year, I was not told about an increase in by Cintas, so that's why I'm projected to be short. So I'm transferring 4,000 from my fuel oil, which we should be fine with, to the uniform and clothing account.
Okay, questions from Brian on this request?
If I
Okay,
may,
sure, Josh.
it's not really on the request, but before we move on, I would just like to make the board aware, due to some, various unforeseen expenses, there is a possibility that we will have to come back to the board for monies for purchase services down the road, as it's only January and a good percentage of that account has been used. So just keep that in mind moving forward, so it's not a surprise when we get there.
Okay, thanks, Josh. Questions? A motion's been made and seconded, correct? Or did I miss that?
Joe, I just like to point out on the agenda that, or not on the agenda, on Brian's letter, it's for 25, but it actually should be for 26 fiscal year.
Okay, same thing, okay. That's
Yeah,
fine.
same thing as with,
Right. It says 25, 26 on his letter, so that's good.
oh, okay, just the agenda.
Okay.
Okay.
Yep. Okay. Very good. Where are we? I guess all in favor?
Oh, you need a motion.
Do
I
we
mean,
have
I-
a motion? I move that we approve the transfer.
Second.
Okay, motion's been made and seconded. Discussion. All in favor?
Aye.
Aye.
Aye. All right, thank you. All right, item number 11 is to discussion regarding future policy considerations for fund balance, reserves, and debt service. I know we're approaching the 9:30 hour, so but I did want to kind of continue the conversation that we started over a year ago with regards to the possible need for a debts fund balance and debt service policy. And historically, I'm not, I go by the view, if it's not broken, don't fix it. But I think that, in light of the town's very fortunate position of having a very healthy fund balance and other reserves, there's continually, through the elected process, new people coming on and serving. We have a new administration. We have new RTM members. We have new Board of Finance members. We have a new finance director and a retiring finance director. And we have, different players. As you see, the actuaries are, Steve is retiring. So it's healthy to go over as to, how we got here and whether or not we should make adjustments along the way. And so, as we all know, the Board of Finance is an appointed board. We're appointed by the Board of Selectmen, who are elected. We have a role that's set up in charter, and we have roles and responsibilities that are not only in the charter but state statute. And so, but Branford is unique in many ways. One is that we are an appointed board; we're not elected. Many boards of finances around the state are elected, and they have a different calling to some extent. We are a board that many times is impartial, non-political, but we have to also make sure that we're in tune with the times and such. Jim did provide us with a draft policy for fund balance as well as for debt service, which we've distributed, and we can contemplate that down the road. And if what I thought tonight is to kind of bring it out in the open and understand that Jim also provided us with some and to me, which I forwarded on to you folks, some studies by the GFOA, the Governmental Finance Association of America, that Jim has participated in. I did years ago. A very good group, at times scholarly, and looks at not only state to state, but also across the nation. So many times there's a lot of as we know, there's each municipality and or county or state is deals with different things, not only different financial and tax regimens, also what their liabilities and risks are. But what's interesting about the GFOA documents is it says, is it time to rethink reserves and, not just look at it as a fund balance, and for us, not just to look at it as a number that we plug the budget with to make the tax number change, because as we know, the primary driver of the tax rate in Branford is not only the expenditures but the taxes, the actual tax levy that we end up imposing due to the relatively, I guess, small revenues compared to, let's say, other larger cities in the state. And in context, I think to look at, again, this is Jim's last meeting, so I don't want to belabor it. But we, over Jim's tutelage, he's picked up the ball back 27 years ago, and since probably the early 70s, the Branford has, really strived to improve its credit rating and has been very active in the bond market, either short-term notes, investments, long-term bonds and such, to fund all sorts of capital and expenditures. And during that period of time was primarily for sewers and obviously schools and roads and such. When Jim came in, he just enhanced on the development of, the financial strategy and we've been an outlier in many instances, not only, let's say, the OPEB trust or the coastal resiliency, self-insurance, we've been pursued on that to very, very good end for the town. Our pension investment policies that we've adopted, the sinking funds that we have across the board, which then again put over time, they smooth out the burden to the taxpayers. Performance-based contracts for energy, to name a few, coastal resiliency funds. So we've identified, and this kind of ties back to what the GFOA says, is that in their documents, that it's really a risk-based analysis as to what your reserves do and what purpose they are. So in light of that, we know that there's pressure to say, why wouldn't we return some of this money back to the taxpayer? Why don't we reduce the taxes? And I think the board has plugged in, I use that word, has used fund balance as a balancing item in the budgets forever, and increased it or decreased it over time based on really what some of the pressures were or what the risks were for funding. So I think it's not a complex topic, but I think there's many components of it. And the fund balance does tie, and the use of reserves ties closely to the debt service policy, because again, we look at that as to how we can fund some of the needs, and we're again fortunate whether or not we buy a fire truck for cash, or in the old days we'd bond it for a period of time. But we know we have a large amount of capital items that are going to come before us, not only for the schools, possibly the treatment plant, and other types of capital expenditures that come forward. So we need to be cognizant of that whenever we look at fund balance and what it means. Now, recently, the S&P had the review back in October pointed out that, yes, they maintained and reaffirmed our AAA rating. They also kind of expected in their report that we would maintain at least a 35% percentage for fund balance or reserves as a percentage of operating revenues. And yes, we are higher than that, and we're fortunate. and we need to say, okay, well, what happens over the next 3 to 5 years, and what might we do to mitigate any large increases that may come in fund balance based on things that may not be expected during the budgetary process. So again, I just offer that as an opener. Again, tonight we're kind of running a little bit longer than I expected, but I'd like to hear some comments from the board members and maybe Josh and Jim and Catherine, at least to maybe what some of your views might be on a brief basis. So maybe Yvette, I'll start with you.
Yeah, I mean, I think it's prudent to try to maintain the balance as much as possible. I think it would be penny wise and pound foolish to try to do a very small lowering of taxes and then have to hit people up for a big increase down the road. As I said when the topic came up with the contingency fund last year, we have, the snowstorm, we have the hurricanes that come in. We've got so many different issues that can hit us hard at one moment or another. And I think it would be really prudent to try to have as much ready to be able to deal with them. I don't mean too much, but enough. And I think that that's where we are in order to keep our bond rating as good as possible so that we're paying the lowest possible interest. And that we're prepared to be able to handle those emergencies. I mean, I believe that it's a good way for a household to live, and I think it's a really good way for a town to live. Thanks.
Thanks, Yvette. I'll go to Harry and then Deborah after that. Harry?
Am I on?
Yes, you're on.
What? Okay. Well, I guess to say, Joe, you and I are, we won't use age, but the two senior guys, who you with a lot of years, me with a few years of discussing this, and it's not something that just came up. And I think what Yvette said is it. I think going forward, we need to set a floor, a balance, and look at the differences of what our capital needs are, improvements, and what we say the heavy duty equipment like fire department, public works, et cetera, et cetera. So I think as our new constituted board of the six of us, we've got to work together to figure that out and see how we either work a dollar or a percentage, but nothing more each year, to keep a healthy balance. Because even, part of that shows how well the town is run. It assists us in keeping an excellent bond rating. And I think that's important because we do go to the market to buy and sell. And I think we want to be able to continue that because the good work of the previous boards of finance, which are always three Republicans, three Democrats, come together and have constituted good budgets and proper management. So our job going forward is to continue that. That's it.
Thanks, Harry. Deborah?
Thanks. I have to say, I certainly agree with the comments that Evie and Harry have made. And I think that Branford is certainly in a very enviable position compared to a lot of towns, including some of our immediate neighbors. And I think that's due in no small effort from our finance department and just the way that our funds have been managed. I think that it's absolutely prudent that we keep an adequate fund balance, to help us with some of the capital projects. Joe, as you said, some of the capital projects that we have coming up, as well as to defend us against a catastrophic loss. which, especially being a shoreline town, is not outside the realm of possibility. We have our coastal resiliency fund, which would help us in that eventuality, but to have a good, strong fund balance is really in everybody's best interest. And to keep in mind that to have, some kind of structure around what we have, I think is really important so that we can really maintain that thought of sustainability in terms of what that kind of funding is used for. Again, in terms of sustainability, and that aspect of budgetary smoothing. Those are all things I think that we need to keep in mind. But again, the comments that were thrown out about the percentages, that 35%. I think that's more than reasonable in terms of what the rating agencies are looking for. And that, the amount of money as a percent of the overall budget that again would sustain the town in the event of that type of emergency or the need for big capital projects.
Thanks, Deborah. I know that in the GFOA, they did talk about the parametric insurance types of things for those types of catastrophic events that, again, that's what they look at as far as the strategy of not only looking at reserves for various reasons, but also how it's risk, management and how it may tie with types of insurances and such. Alfred and then Fran. You have comments, Alfred?
Yeah, great. Thank you, Joe. As a new member, I never thought much about fund balance and how it relates to annual expenditures. And when the subject came up, I thought, geez, I better educate myself a little bit. So what I did is I went to the states. The state of Connecticut has a kind of a register which they publish annually, and it's all financial statistics from just every state, city, town in the state. And it talks about all sorts of things. Talks about fund balance. Talks about how much education costs. I mean, it's just everything that you could come across in connection with a municipality, how it spends its monies, how much it raises, etc. So I went on that, and I've heard some comments from, I guess, past board meetings that issues about our risks. Our risks are higher because we live on the shoreline. We don't want to lose our AAA bonding. So I went on specifically to try to hone in on some of those issues. And I'm not saying this is it. This is what we want to do. I just think that if we're starting a conversation among all of us to come up with a target, which is the right number, I think you have to understand what other towns are doing. The first thing I took a look at is I took a look at the per capita income of Branford. And then I went to get a list of all the municipalities in the state that has a per capita income the same or greater than Branford, thinking that, hey, these are probably more affluent towns, so be interesting to see their approach to their fund balance. So when I did that study, I studied 34 towns that fell in that category. And basically, what it came up with was the average fund balance relationship between fund balance and annual expenditures was 17%. Ours is 39%. This average of similar towns, similar economic status is 17. I said, oh, that's a little weird. So then I went on and we live on the shoreline. We all have this risk of strong storms that come along, not every year, but every once in a while, and certainly are scary and they're expensive. So I took all the shoreline towns, starting in New York, going up to Rhode Island, pulled those out, did a study on those, compared those, and they came up with an average fund balance relationship of 17% average, which was I thought they might have greater fund balances because of their greater risks of that. It came up to 17%. So then I said, okay, how about the bond ratings? Uh, Maybe the bond ratings, the ones that have the AAA bond ratings, have greater fund balance relationships. So I went into the study of those. There were only 17 towns that had AAA published in this report. Of those 17 towns, again, their average fund balance was 17%, and ours is 39. So I'm not making a conclusion on that, but I think that is an extremely important issue to chat about as we deal with this issue is what is the proper value. There's a base of basically every town in the state has a relationship of the fund balance to expenditures of 17 to 20%. It's in that range. We're 39. And we happen to be, we're a mature town. We have a long history of financial dealings. We have great management, very strong management. And here we are as an outlier in terms of that one statistic. So I'm not saying that's right. I'm not saying that's where we should be, but I think we cannot ignore that. So in our discussion of what our risks are and what we should be covering through a fund balance, we've got to pay attention to what the people around us are doing. So that's what it is. I just want to participate in that discussion and make sure we don't lose sight of we are an outlier from the average of the state of Connecticut.
All right. Thank you, Alfred. Appreciate that. Fran?
Well, I again, being new to this board, just learning a lot about it. But all the comments made by yourself, Mr. Chairman, and all the committee members, I certainly understand from the outside looking in now that there are things we could probably look at to fine tune our fund balance. Rather than discuss some of the fine thoughts that were already brought up, I would probably just want to wait until we really sit down and have discussions on it, where I'll probably have more questions and I've done some more research myself. So, but
Okay.
I like all the thoughts, and everyone made very valid points. And I agree with all of them. So,
Thank you, Fran. Yeah, I'd like to have Josh, Catherine, and Jim, maybe in that order. Josh, if you like to make some comments.
Sure. The one thing I would caution is, I mean, this is such a hard. It's not an easy answer. There's no easy answer here. It's very complicated. But it's a great problem to have, right? I'm a very conservative, fiscally conservative individual. As Catherine will tell you, I look at every bill and it doesn't matter how much it is, it hurts. But I would caution this body or anybody in the town to set hard and fast rules, right? So if we say, all right, we're going to set a policy of, I'll say 35% and a floor of 20%. So, something like that. I'll use those percentages as a thing. What it does is I feel like it hamstrings us in how we move forward. So, for example, the wastewater treatment plant in September gets blown away, and we have to spend, I wouldn't even begin to know how much, but $100 million. And we don't have a choice. We have to have our sewers. We got to spend $100 million. If we set a floor, it limits us and how much of that fund balance we would, be able to spend, or we could spend it, but then we would need to tax it if we had a policy. So from that aspect, I would caution a policy, but perhaps more of guidelines if it feels like a little bit less restrictive. The other thing that I've noticed and I struggle with when I'm preparing for this budget and in my discussions with Jim and Catherine, $6.5 million of the fund balance went towards smoothing out taxes on the reval last year. So in order to try to keep taxes where they are, right? If that was my goal, I need to add $6.5 million from the fund balance. And if we're going to do that year in and year out, it gets harder. The fund balance can't grow, right? And I'm not saying it needs to grow now, but it needs to be thought of is as our budget grows, and it's going to grow, we all know it. The amount changes in the percentage. So I did some math, and if $50 million is 39% this year, next year it's 37. Like my math could have been off because I don't know. Anyway, 37, and then the subsequent next year it's somewhere in the neighborhood of 34.5. So if you hold it at 50 million in a few years, it starts to fall in that percentage way, and then you're not taxing to keep up a percentage of the fund balance. So I would caution in how we use fund balance. Yes, I don't think anybody disagrees that there is an opportunity because we have, more savings than is expected of any town, and percentage-wise, we have an opportunity, but how we spend it matters. And I think that needs to be our focus moving forward, more so than the percentage, that we spend it in a way that we don't, from one year to another, if we were going to stop spending it, it jumps drastically on the taxpayers. And I think, to me, that's the most important issue, how we spend it and using it for the right opportunities. So that's my 2 cents.
Thank you, Josh. Much appreciate that. Catherine, you have a few comments as the new finance director?
I do, and I'm going to apologize if I start coughing in the middle of it. I think that as you're looking at percentages and you're trying to develop a policy, I think it might be prudent to bring in Mark Chapman, our financial advisor from Munistat Services. He was with Jim, myself, and the former first selectman when we were on the call with the rating agencies, getting our bond rating reaffirmed. So, I think he could provide a lot of valuable guidance. I think that, part of the conversation with the rating agency was, they had asked us what our plan was going forward with fund balance, and how we use fund balance, and, somehow how we, during the budget process, it is not just about, lowering that tax rate, but it is also looking at maybe pulling out one-time capital needs and funding those needs out of fund balance to, smooth out the increase from year to year. I think that Branford has a very strong financial, we've been strong in our financial processes for years, and I think that it would be very wise to ask what our financial advisor thinks that range should be. I don't know what that range should be either, whether it's 20 to 25%, 25 to 30, but I do know that the rating agencies are looking at those numbers across the state, not even just the state, but the country. And I think, and I apologize, I'm really under the weather, but that was my 2 cents. And I agree with Josh, use it wisely, so that there is not an increase that jumps from year to year for the taxpayers. Um, is a wise decision. I'm sorry, that's it. Did I cut out?
Joe's trying to talk. Joe, are you muted?
Oh, I'm
Is
sorry.
Joe muted?
No, he's not, but Joe, we've lost your sound. Still can't
No.
hear you. Oh,
Oh.
there.
Talk.
The Zoom, we're getting zoomed out here.
Yeah.
Can you hear me now?
Yeah, I can hear you.
Yeah, I
Okay,
lost
Jim,
connection too there for a minute.
okay, yeah, I know you were in and out, Catherine. So, Jim, some final remarks, and then we're going to wrap up. But again, what I do want to appreciate is Jim has done a lot of work on this. He's been a really key over the years on the strategy. And again, we've usually set up different transfers, in advance of the budget process in order to try to mitigate impact of just the tax rate, which again, many times came out of fund balance. So, I think we're very cognizant of it, but obviously, we're moving forward and make adjustments as we need to. Jim?
Yeah, thank you, Joe. I think I think everyone who has spoken before me has made some excellent points. So that's one of the challenges, I guess, with going last is you have to kind of try to add something in a conversation and synthesize some of what's already been said. So I would say that, the more I've thought about this over the years, the more vexing the problem is. Let me first say that you probably want to set a range so that you're not necessarily hitting a specific target, depending on where you set the range and what's between the high point and the low point is going to give you some flexibility. I do think it's mindful to take into account some of the changing philosophy on fund balance. I don't know if other communities are looking at it that way. I do think that there's value in Al's analysis, looking at the OPM fiscal indicators and seeing where other people are. And then, so that's part of the question. Do you look more locally or do you look broader? So, for example, nationally, we know that the numbers are higher. The Government Finance Officers Association, from what I recall, at a minimum, would talk about having 2 months in reserve, and 2 months in reserve is strikingly close to that 17% that Al, you had found was the mode in terms of looking, or average rather, just looking at all the different communities. I think you have to kind of factor in all the various stakeholders. Obviously, the citizens, the bondholders, and the community. I think if you were to put a private sector hat on, you might look and say, well, how are we allocating capital for the benefit of the citizens? I think that's a broader way of looking at it. And I do when you're looking at individual towns for comparison, one of the things to take into account is if you're looking at a shoreline town that they may not have treatment plants. So, for example, Clinton, I don't think Clinton has a treatment plant. I don't think Old Saybrook does. I know Guilford doesn't. I know Madison doesn't. Catherine mentioned about Mark Chapman with IBIC, our financial advisor, because fund balance is one of the factors the rating agencies look at. But it would seem logical to me that a community with a lower fund balance could offset that with high wealth levels. So that's kind of how you look at it. And in the end, I don't think there's a perfect formula because I've asked that question at conferences. I've asked questions of panelists or a series of panelists saying, well, what is the right formula for reserves? I said, the rating agencies that want to see a certain amount of reserves. Your taxpayers want to see you put some reserves to basically offset part of the taxes. Branford's putting dollars in a coastal resiliency fund. Branford buys insurance. Well, are we effectively underinsured? Is there an argument that maybe we need to have a more detailed analysis of our insurance needs? And then the question is, add to, keep a portion of reserves for that, or do we transfer the risk through insurance? So there's a whole series of things to take into account, and there may not be a right answer. Right? It may be what you're comfortable with, what you could defend publicly, and what you could define that's in the public interest. And so I think, also, I think for the new members, you're going to go through the budget process. That may influence your thinking on fund balance. I don't want to make any predictions whether it will or not, but I think that's obviously a factor. And the Board of Ed, as we know, is I think their capital plan that was mentioned the other night at their meeting, so I think is $250 million. That's right, $1 billion. We're working with our state reps to try to, improve some of our reimbursement rates. That's a strategy. It's not guaranteed. So those are some things to think about in terms of what you're going to be in the market in future years. And, the fund balance and cash is going to help you in terms of timing those bond issues. And so that's important. So I guess in summary, I'll just say there are a lot of factors to consider. The more, the better, but at some point, you're probably going to have to come down on a range of numbers that you could defend and one that's sustainable and what works for Branford. You want to understand what's going on in the rest of the world, and certainly what's going on in the nation is a little bit scary in terms of what the risks to communities are. You have a treatment plant that's on the water. BRIC funding is going away, so those are some other things to think about. So, but I think it's a good start. I think we drafted something. The rating agencies have asked us if we have adopted policies, and we say, we show them our budget letter, but we also tell them that we're working on draft policies. So I think, Joe, you hit it right on the head. You had changes, turnover, transitions, and I think that's where kind of the rating agencies have asked for these policies because, for the last almost 28 years, they've heard from the same people. So all
right, Jim, much appreciated. Okay, I think that'll be the wrap on item number 11. Item number 12, I think, was a placeholder. Josh, you don't have anything that we need to add to the agenda, do you, at this point?
Things. I don't have something we're going to add to the agenda, but as I'm sitting here with my other computer, and I was thinking about this earlier because I had read the email, but it didn't ding into me until now. We did not, I say you, the Board of Finance did not vote on to rebalance the police plan. I don't know if that's something you need to do, but there wasn't a vote. There wasn't a vote to.
I thought we did that, Trista. Did we?
Yes, I have Al as making the motion and Fran seconding it for the rebalance.
Okay, well then I'm sorry. I apologize.
That's okay.
That's how I raised my hand.
It's good to keep an eye. It's good to keep an eye on us.
We got to keep you honest, Joe. I know that.
That's it.
I just wanted to say, I started working for the town 27 years ago. And, I was just a kid. I didn't know much about anything, but I was, always kind of there and just hanging around. And I met Jim Finch, and I've known Jim Finch for 27 years. And I'll say of the people that I have met in my lifetime and had a continuous relationship for that long, there's almost no more of a stand-up guy than Jim Finch. And I just wanted to thank him. It's 10 o'clock at night. Jim Finch doesn't need to be here. He could have sicked Catherine on us, but he's here, and that goes to the character of him. So I just want to, this being your last meeting, Jim, on this level, probably your most important level. Thank you very much. Not from just me, but from the 30,000 people that depend on you on a regular basis. So thank you so much for all of that. When I see you tomorrow, I'll give you a noogie or something. But for now, thank you very much, and we appreciate everything you've done.
Here, here.
Here, here,
Josh.
Josh.
Thank you, Josh.
Congratulations.
I appreciate it. Thank you, Josh. Appreciate it.
Yeah, I tell you, Josh, you said it all. But Jim has been such a valuable part of the town's administration and so important asset to Board of Finance and RTM and all the boards and commissions and departments. It's just Catherine's going to do a great job, and Jim will be missed. So, but Jim, it's been a pleasure. I've always enjoyed our relationship, and I know the board members have really really appreciate what you've done for us. To wrap up tonight, what now? What?
You opened it up, Joe.
Okay.
Yeah, no. This is going to be very brief. I just want to say thank you to the Board of Finance. I've enjoyed it immensely. Working with you, and a lot of the things that makes Branford special wouldn't happen if it wasn't for the Board of Finance. And Joe, you've been an exceptional chairman to work with. You've been a friend. You've been a good person to bounce ideas off of. And I don't know if a lot of people know this, but there's lots of times when we're discussing budget issues where Joe and I will talk to each other and we'll just say, are we good with each other? Because we're debating things, over the years, and maybe it looks like, it's there's never a disagreement, but Joe, your input's been invaluable. You've made me a better finance director. I appreciate that. And I'd be remiss if I didn't mention all the other folks that I've had the pleasure to have worked with on the Board of Finance. Don Jackson was the first, and all of them who are no longer with us. Don Jackson, the first chairman, Charlie Shelton, Lorraine Young, Ken Kaminsky, and more recently, Victor Casella. So, I just want the public to know that they're part of this Branford legacy too. And I've enjoyed working with all of them. So thank you.
Thanks. Thank you, Jim, and best of luck, my friend. Okay, so I'd just like to also thank Lisa Arpin for her longstanding role as town clerk and the board, board clerk. And she's moved on to greener pastures. And thank you to Trista for stepping in tonight. Much appreciated. Quite the long meeting tonight. And I guess with that, I will entertain a motion to adjourn.
So moved.
Moved. All in favor?
Aye.
All right, folks. Thank you very much, and we'll see you soon.
Have a
Thanks.
Good night. Bye-bye.
Take care.
Good night.
Good night.
This program was brought to you in part through the support of the Town of Branford. Watch town meetings and other videos on demand at BranfordTV.org.